Let me ask you something that most financial books never ask. Why do smart people make terrible decisions with money? Not uneducated people, not careless people. Smart, informed, experienced people. People who read financial news, who understand compound interest, who know what a good investment looks like, still go broke, still make catastrophic financial mistakes, still end up with far less wealth than their income should have produced. Meanwhile, there are people with average jobs and average incomes who quietly, steadily, without ever making headlines, build enormous wealth over their lifetime. People who never invested in the hottest stock. People who never started a company. People who simply made a few good decisions and stuck with them for decades. What is going on here? Why does financial success seem so disconnected from financial knowledge? That is the question that Morgan Housel set out to answer. And in 2020, he published a book that gave one of the most honest, most insightful, and most human answers to that question that has ever been written. The book is called The Psychology of Money. It has sold over 4 million copies. It has been translated into more than 50 languages, and it has fundamentally changed the way millions of people think about wealth, investing, and financial decision-making. This is not a book about spreadsheets or stock tips or economic theory. This is a book about something far more important and far more overlooked, the way human beings actually think and feel about money, and how those thoughts and feelings determine outcomes far more than any financial strategy ever could. In this video, I am going to walk you through every major idea in this book in detail. I want you to come away from this video not just with information, but with a genuinely different way of seeing money and the decisions you make around it. Let us begin. The core premise: no one is crazy. The book opens with one of the most important and most liberating ideas Morgan Housel puts forward. And it is this: when it comes to money, no one is crazy. That sounds like a strange place to start a book about financial wisdom, but Housel means something very specific, and it is worth understanding deeply. He says that everyone, every single person, makes financial decisions based on their own unique life experience, the decade you grew up in, the economic environment your family lived through, whether you experienced poverty or stability as a child, whether money was a source of fear or security in your household, what you watched your parents do with money, what the adults around you believed about wealth and spending and saving. All of these experiences shape a lens through which you see every financial decision for the rest of your life. And here is the critical point. Two people can look at the exact same financial situation and make completely opposite decisions, and both of them are behaving rationally based on their own experience. Housel gives a compelling example. Someone who grew up during the Great Depression, who watched their family lose everything, who experienced genuine hunger and destitution as a child, that person is going to have a visceral, deep-seated terror of financial risk. They are going to hoard cash. They are going to avoid the stock market. They are going to prioritize security over growth at almost any cost. From the outside, a financial advisor might look at that person and say their behavior is irrational, that keeping all your money in cash is a terrible financial decision that costs you enormous returns over time. But from the inside, from the perspective of that person's lived experience, their behavior makes complete sense. Their brain learned a survival lesson in childhood. When things go wrong financially, everything falls apart. And that lesson does not disappear just because someone shows them a graph about compound interest. Now contrast that with someone who grew up in the 1990s during one of the longest bull markets in history. That person's formative financial experiences were mostly positive. Stocks went up, people got rich, the economy boomed. That person's lens on money is fundamentally different. They are going to be much more comfortable with risk, much more willing to invest aggressively, much more optimistic about long-term returns. Neither person is crazy. Neither person is irrational. They are simply operating from completely different experiences of what money does and what the world does to money. This is the foundation of the entire book. And the reason it matters so much is this: before you can make better financial decisions, you have to understand the lens through which you are currently making your decisions. Because if you do not know where your financial beliefs came from, you cannot evaluate whether they are actually serving you. Lesson 1. Leak and risk, the forces you cannot see. The first major lesson in the psychology of money is about two forces that shape financial outcomes more than most people acknowledge: luck and risk. Housel makes an argument that is uncomfortable for many people to accept. He says that success and failure in financial life are heavily influenced by factors that have nothing to do with intelligence, effort, or skill. Factors that are invisible, unpredictable, and completely outside your control. He uses the life of Bill Gates to make this point. Gates was extraordinarily smart. He was extraordinarily driven. He had exceptional vision and exceptional ability. But Housel points out something that gets overlooked in most telling of the Gates story. Bill Gates attended Lakeside School in Seattle, one of the only high schools in the entire country in the late 1960s that had a computer terminal available for student use. Out of roughly 300 million American children who were alive at the time, Gates was one of only a few hundred who had access to a computer as a teenager. That was luck. That was a circumstance completely outside his control that put him in the right place at the right time to develop a skill that would become the most valuable skill in the world just a decade later. Now, Housel is absolutely not saying that Gates does not deserve his success. His intelligence and his work ethic and his decisions were real and they mattered enormously. But he is saying that you cannot fully understand any person's financial outcome, including your own, without accounting for the role that luck played. And here is why this matters practically. When you look at financially successful people and try to extract lessons from their success, you have to be extremely careful about which parts of their story are actually transferable and which parts were the result of specific lucky circumstances that cannot be reproduced. The same applies in reverse with risk. Housel talks about a young man named Kent Evans, who was Bill Gates' closest friend at Lakeside and was every bit as talented and driven as Gates. Kent Evans died in a mountain climbing accident before he could graduate high school. One piece of bad luck ended a story that might have been as remarkable as Gates's. The lesson is not to be passive or fatalistic. The lesson is humility. When you succeed, do not attribute everything to your own brilliance. Acknowledge the role of luck, and when you fail, do not attribute everything to your own inadequacy. Acknowledge the role of risk and circumstances beyond your control. This humility has a very practical consequence. It makes you more careful about the financial risks you take, because you understand that even smart, well-researched decisions can go wrong for reasons that have nothing to do with the quality of the decision. And it makes you more persistent after failure, because you understand that a bad outcome does not always mean a bad decision. Lesson 2, Never Nudge, the Trap of Moving, Goalpost. One of the most psychologically insightful chapters in the entire book is about a concept Housel calls never enough. And it describes a trap that catches some of the most successful, most accomplished, most financially successful people in the world. The trap works like this. You set a goal, you reach it, and instead of feeling satisfied and secure, you immediately move the goalpost further. You need a little more. A bigger house, a faster car, more status, more security, more, always more. And the truly dangerous version of this trap is not just that it prevents happiness, it is that it can push people to take increasingly irrational risks in the pursuit of more, even when they already have more than enough. Housel opens this chapter with one of the most striking stories in the book. At a party on Shelter Island, the author Kurt Vonnegut pointed out to his friend Joseph Heller, another celebrated author, that their host, a hedge fund manager, had made more money in a single day than Heller had earned from his enormously successful novel, Catch-22, in its entire history. Heller thought about that for a moment and then said, "Yes, but I have something he will never have. Enough." That word, enough, is one of the most powerful and most rare words in the entire conversation about money, because most people in the modern world, particularly in wealthy societies, never allow themselves to feel it. They had been so thoroughly conditioned to want more, to compete harder, to upgrade constantly, that the concept of enough feels almost foreign, almost like surrender. But Housel argues powerfully that the inability to define enough is one of the most dangerous financial conditions a person can have. He gives the example of Rajat Gupta, who had risen from poverty in India to become the CEO of McKinsey and accumulate a personal fortune of hundreds of millions of dollars. By any reasonable standard, Gupta had more than enough. He was set for life, and so were his children and grandchildren. And yet, for reasons that are hard to explain rationally, he got involved in insider trading, risked everything, including his freedom, in pursuit of more wealth. He was eventually convicted and sent to prison. Housel asks, why? Why would someone with hundreds of millions of dollars risk it all for more? The answer, he suggests, is that Gupta had never clearly defined what enough looked like for him. He was surrounded by people who had even more, billionaires and oligarchs, and in that context, his hundreds of millions felt insufficient. The lesson Housel draws from this is both simple and profound. The hardest financial skill is not calculating returns or building a diversified portfolio. It is getting the goalpost to stop moving. It is developing the wisdom and self-awareness to look at what you have and say, this is enough for me to be genuinely happy and secure. Everything beyond this is a bonus, not a necessity. And until you can do that, no amount of money will ever be enough. Lesson 3. Compounding, the magic that requires patience. Warren Buffett is the most celebrated investor in history. His net worth is commonly cited as proof that his investment strategy works brilliantly, and people study his methods intensely, trying to understand the secret of his extraordinary returns. But Housel makes an observation that almost everyone who studies Buffett misses completely. He says, people focus on Buffett's investment returns, but the real secret to his wealth is not the rate of his returns, it is the duration. Buffett started investing seriously at age 10. He had accumulated roughly $1 million by age 30. By age 60, he was worth around $3.8 billion. But here is the stunning part. More than 95% of his entire net worth was accumulated after his 60th birthday. Think about that. He had been investing for 50 years, had made extraordinary returns the whole time, and still 95% of his wealth came in the final third of his life. Not because his returns improved dramatically in old age, but because of the mathematics of compounding, the way that growth builds on previous growth, year after year, in a way that starts slowly and then accelerates to an almost incomprehensible scale. Housel points out that if Buffett had started investing at age 30 instead of 10, and had stopped at 65 to retire like a normal person, his net worth would be roughly $11.9 million, not $360 billion. 11.9 million. 99.9% of his actual wealth exists purely because he started early and never stopped. This is the most important thing to understand about compounding. Its power is not in the rate of return, its power is in time. And time is the one ingredient that cannot be bought, cannot be borrowed, and cannot be rushed. Housel says the most counterintuitive truth about investing is this: you do not need extraordinary returns to build extraordinary wealth. You need ordinary returns maintained consistently over an extraordinary length of time. A modestly good investor who starts at 25 and never panics and never stops will almost always end up wealthier than a brilliant investor who starts at 40 tries to make up for lost time with aggressive strategies, and occasionally makes the catastrophic mistake of pulling out of the market at the wrong moment. The lesson is not complicated. Start as early as you possibly can. Invest consistently. Do not stop. Do not try to time the market. Do not chase extraordinary returns. And then wait. And then wait longer. Compounding does not reward cleverness. It rewards patience. Lesson 4. Getting wealthy vs. Staying wealthy. Two completely different skills. This is one of the most important distinctions in the entire book, and it is one that almost no one talks about. Housel argues that getting wealthy and staying wealthy require completely different mindsets, completely different behaviors, and in many ways completely opposite personality traits. Getting wealthy tends to reward bold thinking, optimism, risk-taking, and aggressive action. The people who build wealth from scratch are often willing to make concentrated bets, take on significant risk, and push hard through uncertainty. They believe things will work out. They go all in. And sometimes that works spectacularly. But staying wealthy requires something very different. It requires humility rather than confidence. It requires caution rather than boldness. It requires the recognition that the same aggressive strategies that built your wealth can destroy it just as quickly if the conditions change. Housel talks about two investors named Jesse Livermore and Abraham Jermansky, both of whom made enormous fortunes in the 1920s bull market. Livermore was arguably the greatest stock trader of his era. His understanding of market psychology was uncanny, and he built a net worth of over $100 million, which in today's terms would be billions. And then the stock market crashed in 1929, and both men lost virtually everything, not because they were stupid, not because they were careless, but because they had never developed the skills and the mindset of staying wealthy. They kept taking the kinds of risks that had made them rich, long after the environment had changed in ways that made those risks ruinous. The key insight Housel draws from this is what he calls the importance of survival. He argues that the ability to survive financially, to stay in the game through crashes, through downturns, through periods of loss, is more important than any other financial skill. He puts it bluntly. If you can keep your head when the stock market falls 50% and the entire financial media is screaming that the world is ending, If you can hold your nerve, stay invested, and not panic sell at the bottom, you will end up far wealthier than the person who had better average returns but could not handle the psychological pressure of a bad year. This is why Housel says the best financial strategy is not the one with the highest expected return. It is the one you can actually stick with through the worst conditions the world can throw at it. Lesson 5. Tails, you win. The reality of how wealth is actually built. One of the most practically important and least understood concepts in investing is what statisticians call tail events, extremely rare outcomes that have an outsized impact on overall results. Housel explains this concept with an example from the venture capital world. When a venture capital firm invests in 100 startup companies, the vast majority of them fail. Maybe 60 or 70% return nothing at all, another 20% return something modest. And then maybe 2 or 3 of them, maybe fewer, become the Googles and the Facebooks and the Amazons that produce returns so enormous that they more than compensate for every single failure in the entire portfolio. That is a tail event, one extraordinary outcome that drives the majority of the total result. Housel argues that this dynamic is not just true in venture capital, it is true in almost every area of financial life. A small number of investments account for most returns. A small number of decisions account for most of your financial trajectory. A small number of good years in a long investing career account for most of the total wealth built over that career. He cites research showing that if you had missed just the 10 best days for the stock market between 1980 and 2020, your overall returns would be cut roughly in half, 10 days out of more than 14,000. The implication of this is profound. It means that in investing, one of the worst things you can do is be out of the market on the rare days when extraordinary things happen. And since nobody knows in advance which days those will be, the safest and most effective strategy is simply to stay invested consistently through the boring periods and the terrifying periods alike, so that you are always there when the tail events occur. It also means that failure and loss are a completely normal part of the financial journey, not a sign that something has gone wrong, but a necessary cost of participating in a system where tail events drive most of the returns. Housel says, you can be wrong half the time and still end up enormously wealthy as long as when you are right, you are spectacularly right. The key is to stay in the game long enough for those spectacular moments to arrive. Lesson 6. Freedom, the highest form of wealth. Now we arrive at what Housel considers the deepest and most important truth about money. And it might surprise you. He says the highest form of wealth is not a big house. It is not a luxury car. It is not designer clothes or fine dining or exotic vacations or any of the status signals that our culture associates with being wealthy. The highest form of wealth is control over your time. He says, the ability to do what you want, when you want, with who you want, for as long as you want. That is the highest dividend money pays. And he argues that this is what people are really seeking when they say they want to be rich. They are not primarily seeking things. They are seeking the freedom to live on their own terms. The freedom to wake up without an alarm clock. The freedom to spend their days doing work they find meaningful rather than work they find tolerable. The freedom to be present for their children. The freedom to pursue their passions. The freedom to say no. The problem is that most people pursue wealth in ways that actively destroy the very thing they are trying to buy. They work 80-hour weeks, sacrificing their health and their relationships and their freedom in the present in pursuit of future wealth that is supposed to eventually give them those things back. Housel says the research on this is remarkably consistent. Study after study on human happiness shows that, beyond a certain threshold of income, once your basic needs and reasonable comforts are covered, additional money contributes very little to happiness or well-being. But control over your time consistently appears as one of the strongest predictors of life satisfaction. This reframes the entire goal of building wealth. It is not about accumulating a number. It is about reaching the point where you have enough security and freedom that money is no longer dictating your decisions. He says, use money to gain control of your time. Because if you have money but no control over your time, you are not rich. You are just well compensated. Lesson 7. Man in the Car Paradox. Wealth is invisible. Here is a thought experiment that Housel presents, and it will make you rethink everything you think you know about displaying wealth. When you see someone driving a beautiful, expensive car, a Porsche, a Ferrari, a Lamborghini, what goes through your mind? If you are like most people, you probably think something like, wow, that person must be really successful. I would love to have that. I admire that. But here's what Housel noticed. When he sees that car, he never thinks about the driver. He thinks about how he would feel driving that car, how people would look at him, how successful and admired he would feel. And his point is this. So does everyone else. Nobody is looking at the car and thinking about the driver. They are projecting themselves onto the image of the car and imagining how they would feel driving it. The driver is essentially invisible. This means that one of the most common and most expensive motivations for buying luxury goods, the desire to earn the admiration and respect of others, almost never actually works. People are not thinking about you when they see your expensive things. They are thinking about themselves. Housel takes this further and makes an observation about true wealth that is genuinely surprising. He says, wealth is what you do not see. The flashy car, the big house, the designer watch, these are not wealth. These are the spending of wealth. And in many cases, they are evidence of less wealth, not more. Because every dollar spent on visible status is a dollar not invested in actual wealth creation. True wealth is the money that has not been spent. The investments quietly compounding in an account somewhere. The financial security that nobody can see from the outside. He points out that the truly wealthy people he has observed are often surprisingly invisible in their consumption. They drive ordinary cars. They live in modest houses. They do not feel the need to signal their success through spending because their actual financial security gives them something far more satisfying than external validation. The paradox is this. The people who look the richest are often not the richest, and the people who are truly wealthy are often invisible to the people looking for wealth to admire. Lisan Jate, save money, the one financial habit that beats everything. Housel makes a point in this chapter that seems almost insultingly obvious on the surface, but which, when you really think about it, is one of the most important financial insights in the entire book. He says, the most important financial habit you can develop is simply to save money, not investing in the right stocks, not timing the market, not finding the best financial advisor, not starting the right business, just saving money. And the reason this matters so much is something most financial advice completely misses. He says that wealth is not determined by how much you earn. It is determined by the gap between what you earn and what you spend. That gap is your savings rate, and your savings rate is the most powerful lever you have over your own financial future. A person who earns $200,000 a year and spends $190,000 of it has a savings rate of 5%. A person who earns $50,000 a year and spends $35,000 of it has a savings rate of 30%. Over time, the second person will almost certainly build more wealth than the first, despite earning a fraction of the income. But Housel goes even deeper than this. He says that saving money is valuable not primarily because of what you plan to do with the savings. It is valuable because of the optionality it creates, the freedom to do things you cannot currently anticipate. When you have savings, you have choices. You can leave a bad job without having the next one lined up. You can take time to find the right opportunity rather than taking the first one out of desperation. You can ride out an economic downturn without being forced to sell assets at the worst possible time. You can say no to things that do not align with your values. When you have no savings, you have no choices. Every decision is driven by financial necessity rather than genuine preference. And that lack of choice, that constant financial pressure, is one of the most corrosive forces in a person's life. He also makes an important point about lifestyle. He says that people should be much less focused on increasing their income and much more focused on reducing what he calls lifestyle expectations, the constant upgrading of consumption that happens automatically as income rises. Most people, when their income goes up, immediately find ways to spend the additional money. The car gets upgraded, the house gets bigger, the vacations get more expensive. And then the new, higher level of spending becomes the new normal, the baseline that must be maintained regardless of circumstances. This is called lifestyle inflation, and it is the single most common reason why people with high incomes end up with nothing to show for decades of earning. The antidote is deliberate, conscious resistance to lifestyle inflation, a commitment to keeping your spending growth slower than your income growth so that the gap between them, or savings rate, steadily increases over time. Lesson 9, Reasonable Beats, Rational. This chapter contains one of the most refreshingly honest things in the entire book, and it challenges something that almost all of financial advice takes for granted. Most financial theory is built on the assumption that people should be fully rational about money, that they should make decisions based purely on data, pure logic, and the optimization of expected returns. Housel says that is a fantasy. And more importantly, it is the wrong goal. He argues that the best financial strategy is not the one that is mathematically optimal. It is the one that is reasonable, the one that is good enough to work well and that you can actually stick with emotionally over long periods of time. He uses the example of someone who holds a diversified portfolio of stocks versus bonds. The mathematically optimal allocation might be 100% stocks over a long time horizon because stocks produce higher returns over time. But for most actual human beings, a portfolio that is 100% stocks is psychologically unbearable during a major market crash. When the market falls 40 or 50%, which it does periodically, the emotional pain of watching that portfolio collapse is so intense that most people cannot hold their nerve. They panic, they sell at the bottom, and in doing so, they lock in massive losses and destroy most of the benefit that the higher allocation was supposed to produce. A portfolio that is 80% stocks and 20% bonds produces slightly lower mathematical returns in theory, but it also produces a somewhat smoother ride that many more people can actually endure through bad years. And a strategy that you can stick with through bad years beats a theoretically superior strategy that you abandon in panic every single time. Housel says, do not aspire to be coldly rational about money. Aspire to be consistently reasonable. Know your own emotional limits. Build a strategy that accounts for them. Because a B-plus strategy that you actually follow for 30 years beats an A-plus strategy that you abandon after 2 bad years. Lesson TN. Room for error, the importance of playing it safe. In the world of physics and engineering, there is a concept called the margin of safety. When engineers design a bridge, they do not calculate the maximum load the bridge will ever carry and then build it to exactly that specification. They build it to handle 2 or 3 or sometimes 10 times more than the expected maximum load. Because the world is unpredictable. Because things go wrong in ways that no model fully anticipated. Because the cost of being wrong about a bridge is catastrophic and irreversible. Housel argues that this same principle should be at the core of every financial decision you make. He calls it room for error. And he says it is the most underappreciated and underused concept in personal finance. Here is how it works practically. When you are planning for retirement, do not assume the historical average rate of return on stocks. Assume a lower return. Build your plan around the possibility that things will go worse than expected, because if things go as expected, you will be better off than you planned. And if things go worse than expected, you will still be okay. When you are investing, do not put every dollar into your best idea. Keep some in reserve. Because even your best ideas can be wrong, and the market can stay irrational longer than you can stay solvent. When you are planning your monthly budget, do not build it around every dollar of your current income. Build it around the assumption that your income might drop. Because jobs are lost, businesses fail, economies contract. Housel says the goal of room for error is not to be pessimistic. It is to ensure that you can survive whatever the world throws at you, because the world will always eventually throw something at you that you did not anticipate. The people who survive financially across decades are not necessarily the ones who made the best predictions. They are the ones who built enough margin into their plans that even when their predictions were wrong, they were not wiped out. Survival is the prerequisite for everything else. Lesson 11. You will change. The danger of long-term plans. Here is something that most financial planning completely ignores. The person you are today, your values, your priorities, your definition of a good life is not the person you will be in 20 years. You will change dramatically. Housel makes this point with something called the end of history illusion, a well-documented psychological phenomenon where people consistently underestimate how much they will change in the future, even though they can clearly see how much they have changed in the past. In a famous study, people of various ages were asked 2 questions. First, how much have you changed in the last 10 years? And second, how much do you expect to change in the next 10 years? Almost everyone acknowledged that they had changed enormously in the last 10 years, and almost everyone predicted that they would change very little in the next 10 years. This pattern held across all ages. The implication for financial planning is significant. Most long-term financial plans assume that your goals, values, and lifestyle preferences will remain relatively stable over decades. But if human beings consistently change more than they expect to, then long-term financial plans are going to be wrong in ways that their creators did not anticipate. Housel says the lesson is not to stop making plans. It is to build flexibility into your plans, to avoid locking yourself into financial commitments so rigid that they cannot accommodate the person you will become. He also says, be willing to accept that some past financial decisions were made by a version of you that no longer exists. Do not feel trapped by those decisions. Do not stay in a career or a lifestyle or an investment strategy that the current version of you no longer believes in, simply out of loyalty to your past self. The willingness to evolve, financially and personally, is itself a form of financial wisdom. Lesson 12. Nothing is free, the price of good. Investing every good thing in the financial world has a price. The question is not whether you are willing to pay the price. The question is whether you recognize what the price is. For investing in stocks, the price is volatility. The price is watching your portfolio fall 30 or 40 or 50% during a market crash. The price is the anxiety of not knowing when the recovery will come. The price is the temptation to sell at the worst possible time. For investing in bonds, the price is lower long-term returns. For keeping your money in cash, the price is inflation slowly eroding your purchasing power. For starting a business, the price is years of uncertainty, stress, and the real possibility of failure. There is no free lunch. Every financial return comes with a corresponding cost. Hassel says the problem is that most people try to get the return without paying the price. They invest in stocks but cannot tolerate the volatility, so they sell every time the market drops. They start a business but cannot tolerate the uncertainty, so they quit before the business has time to become profitable. He calls this trying to steal the return. You want the reward without paying the admission fee, and it almost never works. The right mindset shift is to stop seeing market volatility or business uncertainty as a problem to be solved and start seeing it as a fee to be paid. You are not losing money when the market drops 30%. You are paying the price of admission for the long-term returns that stocks produce. Once you reframe it that way, the question changes. Instead of asking, how do I avoid this pain? You start asking, is this worth paying for? And for long-term investors, the answer is almost always yes. The final lesson. Defining your own financial game. The last major idea in the psychology of money is something that ties the entire book together, and it is a reminder that applies to everything you have heard in this video. Hassel says, you need to know what financial game you are playing. The financial world is full of people playing different games with different time horizons, different risk tolerances, and different definitions of success. Day traders are playing a completely different game from long-term index fund investors. Venture capitalists are playing a different game from retirees trying to preserve capital. People who want to retire at 40 are playing a different game from people who love their work and plan to do it until they die. The problem is that all of these different players often look at the same asset, the same stock, the same piece of real estate, the same business, and give completely different advice about what to do with it. And if you are not clear about which game you are playing, you might start making decisions based on someone else's strategy that is completely irrelevant to your own situation. A day trader might look at a volatile stock and say it is a sell. A long-term investor might look at the exact same stock and say it is a buy. Both of them are right for their own game. The lesson is to get clear and stay clear on what your own financial goals actually are. What does enough look like for you? What level of risk can you genuinely tolerate? What time horizon are you working with? What are you ultimately trying to achieve with money? And then, stop letting other people's financial games influence your decisions. Stop trying to keep up with friends who are playing a different game. Stop taking investment advice from people whose time horizon is completely different from yours. Define your own game, play it consistently, and ignore the noise from everyone who is playing a different one. The final thought. The Psychology of Money is ultimately a book about humility, about recognizing that financial success is not just about strategy or intelligence or hard work, although all of those things matter. It is about understanding the deeply human psychological forces that shape every financial decision we make. It is about recognizing that we all carry a unique lens built from our own experiences, and that lens shapes what we believe about money in ways we are often not even aware of. It is about understanding that the market is unpredictable, that the future is uncertain, that even the best plans will go wrong in ways we did not anticipate, and building a financial life that can survive that uncertainty rather than one that depends on everything going right. And most profoundly, it is about remembering what money is actually for. Money is not the destination. Money is a tool for buying back your time, a tool for creating options, a tool for giving you the freedom to live life on your own terms, to spend your days doing things that matter to you, with people who matter to you. The greatest return that money can produce is not measured in percent per year. It is measured in the quality of your daily life, in the peace of mind of knowing you are financially secure, in the freedom to wake up every morning and choose how you spend your day. That is what enough feels like. And that, according to Morgan Housel, is the whole point. Thank you for watching this video. If something here shifted the way you think about money, please share it with someone who would benefit from hearing it. Subscribe for more deep book summaries every week, and I will see you in the next video.